Welcome or welcome back to Deal Flow. I'm Michael Pouliot. It's January 2026. And if you're investing in multifamily or you just want to keep track of what's going on in the housing market or the macro environment generally, I think you're going to really enjoy this episode that I have here with, some folks, which I'll introduce in a second. We have almost $1 trillion, in commercial real estate debt that's maturing this year. That's 3 times what we saw in the back half of 25. Multifamily distress just hit, it was about 22.8 billion, and CMBS delinquencies are pushing 7%. That's mostly loans originated from 21 and 22, peak of the froth. So the question isn't if a maturity wall is real, it's about who gets hurt, who survives, and where there is opportunity for us with dry powder and discipline. So to break it all down, I've got our usual panel here. I've got Doug Wilson and Hans Box from Box Wilson, and I've got Cody Littlewood, CEO of Carbon Real Estate Investments. And so if you guys want to get the bios from those folks, you can go to our prior episode. We went into more detail on that. We're going to skip that for today and jump right into the docket. So guys, welcome, gentlemen. Nice to see you guys. How you doing?
Great.
Thanks for having us, Michael.
But yeah, no, thanks for coming on and sharing your wisdom and your expertise. So we're going to start with, like I said, the docket. That's rapid fire news. I've got about 9 topics lined up. We're going to try to hit as many as we can. I'll introduce them and then I'll get some reflections from at least 1 or 2 folks. If you want to chime in, Hans, Doug, Cody, on any of these, please feel free. So first things first, can't go an episode of anything these days without talking about Trump and the things that he's saying, doing, and all around the world. So we're going to start with Trump signs an EO banning institutional SFR investors. So this EO was signed on January 21st. It's the 23rd. It's not yet outdated with some new crazy thing that's going to be said. So assuming this will be fresh for at least another few days before he says something else. But this is targeting institutional investors of single family rentals. Reality check, institutions own 3% of the SFR market. So, and there's a build to rent carve out for that. So what's going on here? Is this going to move the market? Is this just political theater? Hans, why don't you take this one? I think you got something interesting to say here.
Yeah, thanks, Michael. I mean, macro, I think it's political theater as much of what Trump may do. It may be him trying to position things, but it's an executive order to start out with. It's not a law. It's not passed by Congress. It's not, in law. So it's not something, number one, that would necessarily stick around with the next presidency. But even if it got that far, I don't know that this is even constitutional because this is a blatant step into the free market. I'm not saying institutional investors don't play around the free market and there's tons of corruption there, but this is quite obviously messing with the free market. And, but let's argue that it actually happened and that he caused it. I do think capital would rotate to multifamily because there's a ton of capital in these build to rent funds in these communities that would need to go somewhere, right? But there would be, also if they have to divest of it, then if you're an LP and you're thinking about investing in XYZ market, are there a bunch of build to rents there? Are they going to have to start selling those off? So now the supply in that area is going to go down. So maybe you want to invest with an owner operator that's possibly owning multifamily in areas where the BTR is becoming, quote, outlawed. But I think, long story short, I don't think this is the biggest thing that LPs or even people like ourselves, owner operators, should be looking at in the multifamily space. There's much bigger knobs. I think, honestly, this is theater. And honestly, I don't think this is constitutional anyway. And I think you have to remember what we do want to take note of, though, this is that something like this, even from a Republican president, and this comes from both parties, both aisles, it is a step in the wrong direction in terms of the way our country was founded. That part can, he does this, and then we have a Democratic president come in and go, well, he did that, we can go do rent control. Then it starts mattering, right? So you do need to keep it top of mind, but I don't think it's going to change anything in the next 2 or 3 years.
So it's more about the unraveling of the fabric of our democracy and not
100%.
necessarily a function of whether or not people can buy institutional housing.
It is.
I did see this morning, maybe it didn't happen this morning, but I think Invitation Homes bought Resi Build, I want to say is the name of the company. And that may be, I'm sure that deal was in the works for a while. So I'm sure it's a little bit of coincidence there. But that, if Invitation Homes can't buy single family homes, then, hey, if they can build them, then that's another way. So there also is a lot of loopholes here. A lot of times it's just how do I say things to the base to
Yeah.
get what I want to say out there. And in reality, does it change the way we do business? Cody, it sounds like you had something to say there.
No, I just think, I mean, you're right. Like there probably always will be loopholes and we'll always figure out a way to win, but I don't like it is like an Overton window shift for a conservative, for a conservative president to start talking about, free market controls. I mean, this was like a big thing that the Biden administration was talking about and everyone was up in arms, myself included. Like, it's stupid. Why, like the number one thing that you can do to bring pricing down is supply, right? Like, and institutions can provide a lot of supply and like, anyways, and they own such a small portion. They're not the people moving the market, right? The fact that, boomers have like, 3% mortgages, across the table are not looking to sell it anytime soon, right? Like that's like a bigger issue, as far as supply and pricing and, of the single family market than any sort of institutional play. So I think like the fact that you're starting to see you're starting to talk about like, I just think these like, these general populist tendencies and what should be kind of the free market defender, right? Like starts to move the balance of what we accept as normal and can be like can start to lead to a deterioration of, of what makes America great. Like you can argue that there's a lot of things wrong with America, but I think what, everyone would say is America's like the land of entrepreneurialism, great capital allocation, right? And like generally like an amazing place to do business, right? And like and if we start ruining that, then then I think we have a lot of problems in our hands.
And capital allocation, that's the key, right? Cody, what you just said there, it's the government deciding where capital should be allocated, which is completely the opposite of the free market and capitalism. And a lot of times it's done with good intentions, but what happens is you squeeze a balloon here and something else changes over here, right? And you don't know what those downstream effects are. You can't predict. Central planning is not possible. And we are, unfortunately, as you said, Cody, seem to be heading that direction, regardless of who's in.
And the administration kind of figured that out very quickly too recently with like the cause and effect of like not thinking things through really, like when they said they were going to cap credit card interest rates. Right. Like that's another like crazy, like what you would normally be like, oh, that's a crazy leftist, like that's a far extreme, progressive kind of like thing that somebody would try to do. And then Trump came out and said he was going to do it. And then I think his administration walked it back and said, oh, actually, we started thinking through second order unintended consequences and realized that, if companies are limited on the interest they can charge, then there's going to be a lack of available credit. Right. And if you crunch credit, obviously you crunch the velocity of money and everything kind of tumbles from there. And so the fact that credit card interest rates high allows people with poor credit to be able to get access to credit. And so there's a lot of unintended consequences that I think are not being very well thought through. But that's like one more thing where it's like, I'm starting to get pretty nervous if we're seeing both sides of the country start to dip their hands into what are really like market forces and try to tip the scales in one way or another just to win themselves votes. And I think that's what those three actions are. They're coming right up before the midterms. And so to me, it's really like, that there's that old saying, like the downfall of democracy is when politicians like start realizing they could buy themselves votes. And it's a little scary that like, we're seeing if both sides start to move that direction, then we have very few defenders left.
All right. Well, on that happy note, we're going to move on to our next copy of the docket, and we're going to talk a lot about central planning. So we're going to talk about the Fed. So
I got a lot to say here too, Michael.
Yeah, yes.
In fact, I think Cody and I are just going to start our own Ayn Rand.
Before we, so this is Powell's final year, right? So he's going to be replaced as the top dog at the Fed. I believe it's in May. So we got a few more months here to go, but we're already hearing the telegraphing and the news and the noise around who's going to be next. The market's suggesting we're going to get maybe a couple more rate cuts. We do this year of 2026, maybe not any in the very near term. And certainly I believe we'll find out next week at the end of the month if we get one in the most recent meeting. But, what does this mean? What does it mean for Powell to be leaving? Is this bullish, bearish? Doug, what do you think?
I mean, that's not the only thing happening, right? He's under investigation, and Lisa Cook is in front of the Supreme Court. I mean, her case is in front of the Supreme Court. I mean, it's
was
crazy.
That the one where she lied about or allegedly represented that she was going to be living in the house versus
Yeah, apparently that was just
yeah.
up
I'm
in the
sure no
court
one's ever done
yesterday.
that before. Yeah.
Well, and that was
has
basically
anybody pointed out the irony of a real estate developer going after somebody for cost overruns in a construction project?
I saw a clip the other day of like the ballroom's going to be 200, now it's 300, now it's 400. Anyway.
Is that million, billion? Who
Yeah.
knows, you know?
Private
So
money.
yeah, I mean the Fed's independence is a big question mark, but I mean the market didn't seem to blink. I mean most people seem to think it's theater as well. The ingredients seem to be there for Fed cuts. I mean the job growth over the last I think 7 or 8 months has been pretty anemic since the beginning of last year, and inflation is by and large seems to be under control. I mean there's this whole thing we talked about last time where the shelter piece makes it look like inflation is actually higher than it is, but it's more or less under control and jobs are struggling. So it seems like the Fed has the right ingredients here to start doing more cuts. I think ironically, maybe all this stuff with Lisa Cook and Jerome Powell may be making them more defiant and reluctant to do the cuts, even though they would have otherwise. But either way, I think we're going to see cuts, this year. Most likely. We'll have to wait and see. I think the bigger question for us is in multifamily is what happens further down the curve, in the 5-year to 7-year to 10-year. And I think the other announcement was that Trump's pushing for more QE and more mortgage-backed securities to be purchased to help drive down the higher, longer terms on the rates. So if anyone knows more about that, others can jump in. But I think, we're likely to see some reduction, at least at the 5-year maybe this year, that will help us in multifamily. Not sure about the 10-year.
Yeah. So let's talk a little bit there. Going to, there was some MBS buying. It's a little bit related to this. Trump said another thing to get the Fed to buy, or at least to max out their cap as it relates to MBS buying. They had about $200 billion worth of room in order to fill up their balance sheet. That seems to have had a positive impact on spreads. So mortgage rates for residential homes did come in a little bit. I don't think it's enough to move the needle, but maybe it's a signal of more buying to come. I believe the spreads between the treasury rates and the mortgage rates are at some of the widest they've been since before the financial crisis, 15 years ago. If we continue to see buying of MBS and balance sheet expansion, which is basically QE, that should be bullish for our space, because it just gets people moving, right? People moving means they're buying stuff, they're buying, they're renovating their homes, they're able to finance certain things. So I don't know if that's bullish though for workforce housing, or is it bullish for single family? I don't know if you guys have a thought on what the impact of that would be if you did see, retail mortgage rates fall to, 4.5, 475. Is that going to be a rush out of apartments into houses, or do you think that that's just overall, lifts all boats type of thing?
I mean, one thing I'm hearing is, home builders are offering rate buy downs to help people get into them. And I think part of the reason they're doing that is, well, I mean, these payments are high, but I think people also don't qualify. So like by bringing these rates down, it enables someone to qualify for a mortgage that they wouldn't otherwise necessarily qualify for. So, I mean, it is impacting, spec home right now, spec homes, because builders are offering these to get people in there.
Yeah, it's tough for the existing stock to compete, right? If you've got 2-point buy down, right, and you're offering 4.5% and all these concessions and everything, it's really, and your brand new product, right, never been lived in. It's tough to compete when you go to the the existing stock. It's older, it needs to be renovated, and you got to pay a 6.25% rate. It's tough. Oh, concessions. We've talked about that before, so I'm going to skip that for now. Maybe we'll touch on that a little bit later. But what I did see is that it looks like the GSEs are increasing the cap, or have increased the cap, Fannie and Freddie, to $88 billion each. I think we mentioned this last time. We didn't get to spend a lot of time on this. So, Cody, is this, confidence in the multifamily sector, or is this, hey, we got a lot of refinancing to do, and so we need to backstop this market, or where is all this, product going to go? I don't know. What do you think?
I think that, they increased their limits, but they also had like a bunch of overrun. I mean, there's a lot of things going with the GSEs, right? Right now they're trying to increase there's an increased likelihood that they're going to be taking them back public, right? and not public like the government, but actually like public like commercial. And so, it seems very likely that that'll happen. And they're taking steps to bringing them back onto the, into kind of their own independent agencies and no longer being government sponsored entities. So I'm not sure how much that has. There's been a lot of overrun. I think they've missed their cap like 3 years in a row just because there's not enough transaction volume, right? Things don't pencil and haven't made a lot of sense for buyers. And obviously we've seen a massive cliff. So I don't know if they just have a bunch of, money pending, and needing to get out. There's probably is a bit of concern, right? With the amount of maturities that are coming due. However, I've read out of the amount of maturities, 50% roughly I read this morning would not be able to refinance into agency debt. The estimates of that. So I think that like you have to kind of take that into account, right? Agency can raise their cap, but if 50% of the debt that's coming due wouldn't qualify for agency debt, whether it's just because it's the wrong type of commercial, right? It's not multifamily. They only do multifamily, right, and housing, or whether it's because it doesn't meet DSCR requirements, or whether, for whatever reason, I don't know, did they need to increase the cap if half of all debt won't qualify anyways? They said out of that half of the debt, the vast majority are probably going to be extending and pretending, which, and some load mods, which does limit losses for everyone. So I think everyone's very incentivized to like get through this period. So there's probably an aspect of that. I don't have like I don't have a stance or a view. I do think it's, I do think that there's overall bullish tailwinds for multi. I don't know that they'll all come to fruition in 2026, but there is a supply demand drop off happening, right? There is a lot of projects that are finishing and stabilizing and are probably going to need stabilized financing, which the agencies, will really like. And that supply will start to dwindle and we'll start to see some broader strengths in, in leasing in general. So I think there's a lot of things that are setting up for a strong backdrop for multi. It'll probably always, as it always does, take a little bit longer to play out than everyone expects. But I don't know that the GSE is specifically bullish or even, necessarily negative. I think there's a lot of components. I don't really have a firm stance.
Yeah, no. I mean, I know that there's a large conference every year in January for bankers, CREFC, I think it's called. Maybe that's not exactly correct, but essentially from what I heard, everyone is bankers are thinking it's going to be a banner year. But I've been hearing the bankers saying that every year since I've been in this business. Every year, the brokers and the bankers are like, this is going to be the best year ever. And maybe that's just a way for them to say positive and optimistic. But it did seem like there was a tone from what I heard from people who attended that, they think that this is going to be a banner year because, Cody, to your point, if this debt can't go to the GSEs, it can't go to the agencies, the banks, the bank lenders, the private credit folks, the local community banks, et cetera, all insurance companies, they're going to be the ones that are going to gobble up this debt if they don't modify the existing, right? So I think that there is opportunity out there for people on the lending space to, do a lot of transactions this year. It doesn't necessarily mean that the sponsors or investors are making a lot of money, but I do think there's going to be a lot of churn, and those debts have to be exhausted and refreshed, and that capital structures need to be redone in a lot of cases. So one or two more here, office to residential conversions surging. So we're seeing that across a lot of the really dense markets, Chicago, Manhattan. I think I saw that Manhattan alone, there's 25 projects, almost 9 million square feet of pipeline for 2026 on conversions, and 38% of all future adaptive reuse nationally is office conversions right now. So that's pretty intense. That's a pretty significant amount of the new supply, or I guess in these markets where new supply is basically, there is no new supply of housing in a lot of cases in some of these really dense markets. Any thoughts on that? I don't know, Hans, if you had anything you wanted to speak to around some of these conversion, opportunities. Maybe there is opportunity there because I know it's in unique markets areas with maybe harder barriers to entry.
Yeah. So, I mean, high level, I don't think it moves the needle a lot for operators such as ourselves, i.e., buying mainly in the South and Texas in that area. It definitely might affect value add buyers in the coast, some of these coastal cities that are very dense, where they're extremely expensive land. where these conversions actually might make sense. But I don't think a conversion like these affects the Houstons of the world, the Atlantas of the world, the Miamis of the world, or any of those types of southern cities, because it's just too expensive and there's too much land, and it'd be much cheaper to build a made to order beautiful multifamily wrap project than it is to take an office, which everybody thinks, oh, it's simple. Offices already have bathrooms and they have, everything is there. You just divide up the floor print and make, 5, 6 units out of a one story, one floor building. And it's not that easy at all, because one example, and there's millions, but one example is there's usually only 1 or 2 bathrooms on one floor for an office. Yet when you build an apartment, you need 1 or 2 bathrooms per apartment. And so the plumbing is completely different. The electrical is different. I mean, there's so many variables. So it can be very, very expensive. And I really only think this will affect supply in the, like you mentioned, Michael, in the very dense, very expensive and older markets, mainly on the East Coast, and then maybe some, like the Seattle, San Francisco's of the world.
Yeah.
They also have to be like beyond the bathrooms, right? They also have to be pretty large units.
That's right.
Or they won't have windows, right?
Right.
I think the depth of the floor
Yeah,
plates
one of
of
many
office.
reasons it's hard.
Yeah. I remember like seeing the Flatiron project, and A, they're going to be ultra luxury. B, you have like a kind of an interesting shape that lends itself to a lot of window space, so it makes sense for resi. But I remember, I think about the office building I'm sitting in right now, right? Either you would have to have some very oddly shaped units, or you're going to have a lot of units that don't have windows.
That's
So I don't know how developers are overcoming that, or if,
And some
I'd be really
I stayed in
interested
a
to see.
Some aren't, Cody. Doug and I actually personally know somebody from our time in another city, I won't mention, but where he did a number of these. I know he did at least he did at least 2 of them, and I'm pretty positive neither of them were successful, and he doesn't own them anymore, not by his own volition.
Yeah.
So
Yeah.
very
I
expensive.
don't know. It sounds tough. I actually stayed in a hotel in Stockholm like 2 years or a year and a half ago that was converted from a building, and it had no windows in the rooms. Like it was that exact situation. But it was a small unit in that was relatively, considering the area it was in, relatively affordable, and it was fine. Actually, for me, it was great because it was like total blackout.
But I don't think it would.
Like an interior cruise ship room,
But would it
I don't
pass
think I'd want to live
US
there.
fire
I wouldn't
code?
want to live there, but maybe they should convert them to hotels and not residential.
And
or they just have to put like artificial windows, right? Like TVs.
Isn't it a fire code issue? I'm
We
pretty
have
sure it's a fire
You
code
could just
issue.
jump through the artificial window.
Yeah. Because I don't think it's like, obviously I think especially in a city like New
That's
York,
interesting.
right? People live in like
That's a good point.
horrifying small boxes, right? Like, and so like, I mean, I've seen just ridiculous stuff in New York, but I think even in the most ridiculous situations, they've had like a little tiny window that theoretically a small child could crawl out of, right?
Yeah. Theoretically. So last one on the docket here before we move on to the meat of the show a little bit, is, we saw a lot of outlooks, right? All the brokerage shops will put out outlooks for 2026. I want to just highlight one that might go counter trend. And then I think, Doug, you might have a couple others there, but Newmark's 2026 outlook, they said decaf stagflation, which, it's a strange term. I don't know if I ever heard before, but basically their base case is below trend growth and stubborn inflation. So still year of transition, which I feel like we've been in transition here, transitory inflation, transitory growth, everything's transitory. It's just so how long is transitory take to, how long is that? Is that a year? Is it 10 years? So not acceleration maybe. So, and the labor market might be that key signal to watch to see if that's going to come true. Doug, what do you have to add there?
Well, I just saw Marcus and Millichap came out with their report like a week or so ago, and they were projecting that supply is going to be a little bit above absorption this year, which, last year there was incredible absorption, last few years, incredible absorption. We all thought, I think, that this would be the year that everything would catch up in 25, and this would be the year of growth. It looks like that's pushing out a little bit longer. Although they did say, which I thought was interesting, they thought 31 of the 50 top markets would see rent growth. So it does seem to be an issue of more the markets that had the highest supply that's still being worked through, like, Austin and Denver and some of those. It might take a little bit longer. So yeah, I think this may be more of a transition year. And maybe 27 is going to be the year that we all start to see, higher growth. I mean, the beauty of our markets that we're mostly going in, they're smaller markets without the large supply, and so we're not seeing this right now. We do have a
Transition
couple
isn't
projects.
necessarily a bad thing, right? It's not a bad thing
Exactly.
that you don't see
Yeah.
growth, because sometimes Uber growth, gets more capital, and then you got more competition, and then then that whole cycle starts over, and then all of a sudden you get priced out of on the buy side. So this is sort of I think a good time right now to be on the buy side. It's a little bit harder to be an operator and to to deal with that, which I think is going to be the next part of our episode here, is really to dive a little bit into this maturity. The key numbers here, as I had said at the beginning, $130 billion worth of commercial real estate debt maturing in 2026. Now, there's always an enormous amount of debt maturing, so I don't want to freak everyone out, but that's still much more than was in 2025. There's a 20 to $30 billion worth of multifamily distress as of last quarter. That's it seems like a lot of money, but not that much, really, when you really think about it. If you think about the fact that Trump just had the Fed buy $200 billion worth of mortgage debt in a day or a month, 22 billion doesn't sound like that much necessarily, and I'm assuming some of that'll get worked out. You've got 7% CMBS multifamily delinquency. So that's at a peak right now. About 60% of 2021, 2022 apartment loans will mature by the end of this year, one way or the other. Maybe there's modifications, maybe there's extensions, but we are getting to the end of what is normally the state of maturity for some of these deals. So that being said, we'll go around here. So anyone wants to start, what makes 2026 different? Because we've been talking about this maturity wall since 24, right? So are we going to see extensions? Is this the come to Jesus moment? What are you guys seeing? Are people going to start taking write downs, taking their medicine, or are we just going to sail into the sunset here? What's going on? Who wants to take first step?
Well, I guess the question is, when does extend and pretend end? And everyone thought, I think it was last year that people thought that would end. Maybe it was even the year before. But
Survive to 25, right?
Survived to
did,
25,
survived
and
to
then we
25.
survived 24, 25, and
Yeah, but I just saw a news article come out today that Bank of Ozark just had their highest level of charge-offs in 15 years. And they've shifted from wait it out to work it out. So maybe they're pretty big. Maybe this is starting to happen this year. I mean, it has to happen at some point.
Yeah.
Rates aren't going down. Supply and rents aren't. No one's projecting massive rent growth. How are these loans suddenly, unless people are just going to keep sitting on these for the next 2 or 3 years until all deals are looking good again? I don't know how long the banks are going to, keep doing it. So maybe the Bank of Ozark here is a sign that it's going to start happening more this year.
I think part of it's also going to depend on the lenders themselves, right? So a multi-billion-dollar debt fund out of Israel, say, may have a little bit more latitude about how long they're willing to wait, or if they want to take over the deal themselves versus, local XYZ bank in Little Rock, Arkansas, that went too much on a value add deal in 21 or 22. So a big part of that, but I agree overall with Doug saying that I think the only thing that could slow down, I think deals that are close to possibly working might be extended, or there might be, some sort of workout where they bring in another sponsor that can help operate it, or maybe put in a little bit of money. But I think personally, my guess is that deals that are in a bad state, that are, severely underwater, are going to have to start being worked out this year, because there's really no way around it. Because I think 27, 28, we are going to have better overall fundamentals for multifamily. And those deals that are close right now, I could see lenders pushing it out to then, knowing that we're going to have better fundamentals. But the ones that are already way underwater, I do think there's going to be some big issues.
Yeah.
wonder
So
what
let's
they're-
talk about who you want to go ahead and say anything, Cody.
I think the issue is also there's very little incentive, right? For them to start. I don't know. I think there might be very little incentive for them to start writing down the book, or to start taking operational control, for as long as people are willing to try to stabilize them. I think I could be wrong, but I think mostly these banks are not interested in getting to a situation where they're putting things up for default bankruptcy auctions in general and trying to stabilize the property midterm. So I don't know at what point, and it really depends on whether they're balance sheets or CLO or CBO. I think it's
And regulation. Some of them.
I think it highly depends on what's backing the debt.
Agree.
But it will be interesting to see, because I just think what we've seen so far is no one is very motivated to start taking buildings, to any widespread degree. And if that starts to become if that starts to become a contagion, then you have like another kind of GFC type thing on your hand, which I think everyone is, motivated to, not to employ. But
do you think their asset? I mean, do you think these assets maybe from a deferred maintenance might be deteriorating some? Like, I don't know how long it takes, but anyone who got in trouble 2 or 3 years ago, they're not putting any money into their property. They're barely hanging on, right? So they're not doing maintenance on their property. I wonder if at some point these properties, maybe it's too short, but I wonder if they start to deteriorate a little bit and they start wondering about their underlying asset
maybe.
as well.
Yeah. I think it's the question is like, what's the decision point? I think is kind of what you guys are saying, right? Is it lender based? So lenders have to take certain actions depending on the type of, where their money comes from. And then, this level of distress was really a function of capital structure. And so I don't think it's as much of, hey, all of these people are bad operators and they're not going to be able to, because of poor operations, that's why the deals aren't working. Even deals that are well occupied, performing well, they're just not worth what they were worth. And so it's a math problem. And so, we either have to, grow that NOI back to that value. I don't know what the lender can do. They're not going to be able to operate the property better, which is normally what you would want to do, is try to recover the asset, maximize its value. And that's what potentially that lender is going to do with the property, and then sell it and get maximum recovery. But, a lot of these problems it's not operational distress, although there's some of that. I think the operational distress is if there is operational distress, it's really a function of that capital structure first and foremost. That's the source. And so I'd like to maybe talk a little bit about, what types of profiles, what types of deals do you think that are kind of in the most risk, right? And I think we all know kind of what that looks like. Just to set the stage here, we've seen a lot of, what we would call syndicators, Lurin, GVA, Tides, a few others, big shops, hundreds of millions, if not billions of dollars of assets under management. And these firms have completely blown up due to, I think, capital structure. I don't know if you guys want to speak to, why is that happening for folks that aren't, living, breathing this every single day. Walk us through, what happened here. Why are these deals in trouble? If we're at 9, the best occupancy we've seen in a decade, right? So if occupancy is strong, what's going on here?
And GVA is out of Texas. In fact, they're based here in Austin, right? It's all. Well, I think we all know what the problem is. The problem is a lot of these deals were bought at extremely low cap rates with the assumption that rents go to the sky and occupancy stays at 95%, and property taxes don't go up that much, and insurance doesn't go that up. So let me back up. Interest rates went up 500 bips on floating rate loans. The volatility in interest rates was extreme, which caused interest rate caps to get very expensive, which means the escrows that were being held back weren't enough to buy the new caps for the extremely volatile interest rates. In Texas, in particular, property taxes almost doubled on some deals. And it's always an issue in Texas, but it was actually pretty bad because values went up. So the appraisal districts looked at the values that everyone was overpaying for. So those weren't the real values in our opinion, but those were the values at the time. And appraisal districts jacked up property taxes. Then we had all kinds of insurance, calamities and issues across the nation, and insurance costs went up in Texas a ton. The same insurance that we were paying in Dallas Fort Worth at one point is now, what we were paying in Houston 5, 6, 7 years ago is now what we're paying in Dallas. Houston's always been high because of name windstorm, but Dallas was, wasn't cheap, but it wasn't terrible. And it's just spiked a ton. Interest rates, two huge knobs on expenses, which are property taxes and insurance. When you've got rate cap escrows going up, when you've
Payroll going up a lot too. Yeah.
Yeah. And then occupancy did drop for a while. Rents in some places, oversupply happened. So rents went down because it was easy to get this cheap debt. So what do developers do when they can get debt? They develop. That's what developers do. If they get money, they develop. And so all of those perfect things.
It's wildcatting. It's like the oil and gas guys. You're not going to stop.
Very much. It is in Dallas, Fort Worth, and Houston. Those are in Austin. It's definitely wildcatting. And so you got like 5, 6 factors so you bought a deal that was that more or less made sense on a 3.5 cap because you were going to expand the NOI, and suddenly all those things hit, and now we're 4 or 5 years later, and those are coming due, and they're way underwater. That's essentially at a very high level.
Sure. Yeah. No.
So by the way, quick question on this, interest rates going up, I think significantly slowed new development, which has helped curb supply. But now if we see the short-term rates substantially fall again, which they're in the process of doing, is that going to make new supply come back online? I'm not really hearing anyone talk about that, but I mean, it could.
I assume yes, but it's
Yeah, but it takes them 3 years.
3 to 4
So
years.
that's the good thing.
Oh,
right?
so
Like,
yeah, I mean, the next few years we're fine.
There'll
But
be a
what
lull
about?
and then it'll all come roaring back as usual. Everyone forgets, and then there's a new crop of people who want to, strike it.
We'll have
usually the
all
cycle's
sold
not
out
that
by
short.
point,
Like it will
right?
probably start to normalize. It will probably start to normalize, but usually the cycle's not that short, right? Like a capital cycle, like we are going to be the out of favor asset class, I believe, for a number of years, right? Probably like, let's say 4 or 5 years, probably we've been out of vogue for 2020, let's say 23, we sat on our hands. 24, we basically sat on our hands. We did one deal, right? 25, we did a couple. And so let's say, we've been I would say there's probably like 3 more years, 2 to 3 more years of being kind of like not a preferred asset class before you start to see like, what usually generally happens, right? Like, the capital cycle is, we're going to be the capital we deploy right now is going to start to earn outsized returns, and it's going to take a couple of years for capital to start to realize that and start to flow back into the space. And then we'll start to overheat, right? But I think most of
I think that's right. And I think just another anecdotal, I talked to a developer here a week or 2 ago in Denver, and he was saying that, Denver and some of these markets have had so much supply increase, right? The rents have come down. So now for them, when they're trying to pro forma out a new project and they're trending their rents from today, they're having to start at today's low rents. And so it's making it hard for them to do new development, so even if the rates are lower, I think these rent hits that some of the bigger cities have been hit, some bigger development cities have been having are going to make it hard too in the short term for them to start, building right away.
Yeah,
And then add the tariffs in and on the build cost and all that.
And add the tariffs in. Yeah.
Well, in Denver at $400K or whatever, $500K a unit, that $10K of additional cost for tariffs is probably not a drop in the bucket. But I think that until
5% rent drop. Yeah,
right, that doesn't help. Yeah, I think you got to get back to the point where those developers can say, "Hey, look at that CoStar report. We're going to get 4% rent growth this year. It's right there on the piece of paper from a third party." And they can't say that today. And I think to Cody's point, I think it's going to be a few years before people, and because we haven't even gotten through this distress, right? Like the banks haven't taken their medicine, the capital structures haven't been restruck. That has to happen before we can start the new cycle, I think. And so, yeah, I think we got some time. I think it's a great time and to be on the buy side. It's a little bit, obviously, it's a struggle to be on the sell side.
Well, it's a great time to be on the buy side, except for the raising capital part.
Right. Well, yeah, you can't have it all, right? Unfortunately,
it is the ironic, like it
right.
is like the the developer's curse that when money's easy to raise, it's like the worst time to be deploying capital. And right now, when it's probably one of the better times to be deploying capital, when I'm really excited about like the surprises to the upside that we're going to see. It's a terrible time to be raising capital. I was talking with somebody earlier today, actually at the same chat that Hans is a part of, and there was a developer that was projecting a development deal at like pretty modest 14 to 18% IRRs, in their OM, which I think is like actually like a really reasonable stance to be taking right now, given like the current backdrop. But there's probably a lot more, it was kind of this ironic situation where like, I think they're being probably rightfully nervous about over projecting high IRRs, given the current environment for which we've been, conditioned, conditioned to be in, like our current market conditions. But the ironic thing is that they're probably going to surprise to the upside, given if they're putting things in the dirt right now when no one else is. They're going to have very little competition when they come online. And B, but the other ironic thing is like, it's hard to do a development deal, to take on that additional risk. You got to be paid for the additional risk. And they're essentially projecting value add IRRs, which is the responsible thing to do, but it's going to be very hard for them to raise for a development deal on those.
Not the risk premium there.
Yeah. So I don't know. It was it's always like a difficult thing to do, right? Like during when, we talk about that internally as well in our investment committee, right? Where like we think there's a lot of reasons to be quite bullish, but you can't in good conscience in a time where things are difficult, be bullish in your cap rates or interest rates or any of your assumptions. Even though at the back of your head, you're like, I think we're gonna surprise at the upside on these because further down the line we see what's coming.
Yeah. So we've talked a lot about all the terrible stuff. Well, where's the opportunity, right? So, it's not all bad news. We got to talk about what, if there's all this distress, if all these people are going to have to turn on the keys or just take a write down or whatever, that means there's going to be opportunity for people to buy. And so and it sounds like the real opportunity window is here where, maybe it's 6 months ago, maybe it's 12 months in the future, maybe it lasts for 3 or 4 years, but we're in the zone here. So then it becomes a question of what represents the right distressed acquisition candidate, right? What do you guys think? What's the type of property? If now is the time to be gobbling up the assets, right? If we had unlimited capital to put to work, what should LPs, for instance, be looking for so far as the deals that make sense to buy it? And you guys were in this cycle in 11, right? And so you guys saw people who bought properties too early and then lost them again, right? People, the '08 crisis happened. People lost their properties in '09 and 10. Someone came in, oh, it's distressed. It's a great story. I'm buying it at half the basis. And then all of a sudden in 2011, they lose the property again because the market took a lot longer to recover. And so you don't want to catch a falling knife. So how do we avoid that and also take advantage of the current opportunity? I'm going to give this one to Doug, and then I'll open it up.
I mean, you're bringing back memories for me when we were buying in 2011. I don't remember, I don't remember that second part where people were catching the falling knife. I actually remember at the time we were very picky on what we bought, and in retrospect, I'm like, man, we could have bought anything and we would have been fine and made a ton of money. But I'm not sure we're at that exact same situation today. I mean, today I think we want to avoid high supply markets where there's maybe that it's dwindling, and there's less supply coming online, but it's going to take time to get through that, and there may still be some negative rent growth. I would love to get into a deal that's not being run well, that's that's got upside on loss to lease, that's got in an area without a lot of supply coming online where we think there's still going to be continued rent growth, and without the risk of a bunch of new supply coming online. Those kinds of assets that that we're looking at are the most interesting right now. It's funny now. I wonder if the wave is going to change. I mean, 5 years ago it was like I just wanted to be in the high growth markets, and now we've been burned a little bit by the new supply, and we're like, now I just want to be in the low growth markets, and maybe it'll swing back the other way. At one point, we'll want to be back in the high growth markets again. I mean, those are kind of the deals right now. I'd love to be, in deals that don't need a massive overhaul of work, and I think we're seeing those opportunities come out, but just enough that they're not. I think also there's not a lot of people buying right now too. I think the people that were burned aren't able to raise capital, and I think we're in this unique situation right now where if we have capital available, and are able to make a deal work, that we can get better deals. The pricing is down. I think I saw 20 on average, 25, 30 or even more percent from the peak. So we're in this pretty good pricing space right now.
Yeah. So
if people are trading,
and give it to either you, Hans, or Doug, just a quick gut check on vintage returns. And there's not a great data on this, but if you go to MAA, which is a publicly traded REIT, and very similar type of product to what we look at, Sunbelt, workforce type stuff. It's not an exact comp, but it's, I think, decent. So disclaimers finished. 3-year total return, -2%. 5-year total return, 20%. That's not annualized, right? That's cumulative total return over 5 years for the, presumably one of the best run, right, operators, depending on how you look at it, certainly most public available. And 10-year return, 110%, right? So you doubled your money in 10 years. What is that, a 7% annualized return? So and then the S&P.
Well, I think the clear message there is don't sell when the market's at its bottom, right? If you're looking back 3 years, 5 years, or 10 years, you're looking at selling today, which would be a bad,
right,
great return.
The idea is just to say that and then the S&P was up 330% over that same period. So the S&P, returned 3 times as much as MMA, but this is across all of them. Avalon Bay, Equity Residential, Six Property Trust, they all performed, relatively similarly. And, MAA had the best 10-year total return actually of those, with the exception of Camden, had a very similar return. So, the space has struggled, right? Especially in this, 1, 3, and 5 year, period. But now that we're underperformed, right now, this is a period of time where it's likely, based on historical precedent, that the S&P is not going to be able to, do 300% returns over the next 10 years. And probably some of these other spaces that have fallen out of favor on a forward 10-year basis are probably going to outperform some of these other places just to get back to par, right? Otherwise, that relative asset valuations don't make sense. And so, so I think that's the opportunity, right? It's yes, the past doesn't look that great. And certainly that 21, 22 vintage stock, I think is a struggle, but the deals that are, getting done today, I think have a really strong potential returns as long as they're well operated. I don't know if you guys want to
I mean,
anything else there.
one comment I'd have is I feel like real estate in general, the cycles are easier to see and a little bit easier to understand. We know, we kind of understand the basic cycle, right? You build a lot and then you see rents come down and occupancies come down, and then you stop building and you start to see them work their way back up, and you have this cycle repeat over and over again. I'm not an expert on the stock market. I always feel like I look at the stock market, I'm like, I talked to my wife about this. I'm like, it's too hot. It's too hot. We got to get out. She's like, yeah, but it just went up like 25%. And you said to get out a year ago. And I'm like, you're right. I did say that because I don't understand those cycles. I think it's much harder to predict stock market cycles and to see them and understand them. And I'm not saying real estate is easy and perfect, but the cycles are a little bit easier, I think, to see and understand than the stock market cycles from my perspective.
I agree, Doug, and I think it's really hard to compare returns from experienced multifamily owner operators versus public returns on REITs. There's so many other variables in it, and so as coming from an LP perspective, if I was an LP and, somebody that was looking to get into it, I think your number one thing you should look for right now in terms of multifamily operators is, have they bought deals like this in the past and they operated distress in the past? Do they understand how to navigate the distress and structure a deal? Not the fancy business plans and all that, but really look at their track record and what have they bought in the past? Have they turned around deals that have some distress? Now, right now, I think is a great time because the distress we're talking about isn't really that bad, as Doug mentioned. There is a lot of it is, has been brought on because people just paid too much money, right, for the deal, and it's not necessarily that there was some black swan, a huge loss of jobs, and the market has gone down, and you've got to somehow band-aid that property. This is more about just running a property cleanly and doing the things that the prior owner operator couldn't do or wouldn't do or didn't know how to do. So I think as an LP, you need to look at it, look at the track record and look at the experience, and are they self-managing? That's usually a positive unless they're a very small group. Self-managing means you can keep your finger on the pulse of it and you can really squeeze out that extra dollar for your investors. So from an LP perspective, it's the same thing that I always preach, is it a good owner operator, and is the capital structure up front done conservatively? In other words, you don't want a bunch of financial engineering. You want a very simple structure that makes a lot of sense and low loan to value and low loan to cost.
I think that's a really good point. Public REITs are kind of funny. I will say the one thing I was just going to chime in about public REITs is that I have a good buddy that has a hedge fund specializing in public REITs. Hans has actually met him and helped him run down some research on a REIT that he believed was going to get acquired, and it was trading at a significant value or a significant discount to the private market value. And so as they were, they could either get acquired and then sell off the assets, at a significant premium upside, or do it themselves at a significant upside and totally liquidate. And there's another guy that I'm more acquaintances with, who's kind of joking. And this hedge fund, I mean, they've done really well because I think they've been mostly targeting, they have a large ownership position in Camden. You look at it, they have like I think 40% debt ratio or something like that. They can cover their debt like X with their free cash flows, and just very conservative and like a steady like compounding over time, yet to your point, has not like produced great returns. And so my one acquaintance kind of joke keeps giving this guy a hard time that you could that specifically when Fermi was IPO'd, with zero revenue. And I think IPO'd at like 15 to $19 billion or something, is that, you actually can make money about in REITs. But you just have to make sure to buy the only REITs that have zero revenue or might be acquired, right? So yeah, it's been a really, I would say, like, the asset class is getting really hammered right now. But just in the public market space, it doesn't make a lot of sense. You look at them and I think, they're trading at significant discounts to the private market, which either should worry us or make us, or make us optimistic about, I guess, buying into REITs right now. But yeah.
Yeah, I think that's an interesting. Yeah, they do tend to take on a lot less debt than their private counterparts, which in the good times tends to be a benefit to the private side, and in the bad times tends to mean that the returns for the private sector are a lot worse than the public side, because they get in trouble and you get more losses relative to the private. And there's just a lot of consolidation, so there's just less every year. There's just less and less public REITs to look at and consider and invested in. So flow of funds is probably a big factor too. And there's like obviously all the tax concerns, and people may just be, a lot of people I think are moving a lot more to private, assets. And so they're like, well, I could rather get my real estate exposure in other types of assets, other vehicles than REITs, just because some of their concerns. And so that might be why there's a discount as well. But hopefully it's not because the REITs have it right and we have it wrong, right? We see that move over time. Transitioning now, I think, from that to that opportunity to a little bit on operations. This is, Cody, more of your world, although I'm sure we could all speak to a little bit. So I want to talk about two things. We did speak a little bit about insurance already, so we can definitely hit that a bit. But then I think it's insurance and it's labor costs, right? So maybe if you could maybe just speak a little bit about how those things are helping, hurting, affecting operations on the ground, and how do you manage those risks? You obviously need insurance, it's lender required, and you definitely need people as much as the robots are trying to convince us that we don't need people anymore.
Yeah, insurance is not just a good idea because it's lender required, though.
Sure.
Across our portfolio, I think we've been
we've come out ahead, actually.
We've been sued like 4 or 5 times this year. Trip and falls and like all these little, it's really, sometimes if you dig into it, you really just, all we do is, right, and this happens constantly, right? Trip and falls or a workers' comp claim or something else, and you just pass it off to the insurance company and they do whatever they're going to do. But even when it seems like a ridiculous claim, lots of times these people are rewarded because the insurance company is like, it's going to cost us 40 grand to fight it, and it's going to cost us 20 grand just to pay this person to go away. And so people are really, these personal injury lawsuits and these personal injury firms and people are generally like rewarded for very bad behavior. But long story short, I guess I kind of, I definitely went down a rabbit hole there, but insurance is coming in considerably, right? We saw discounts across our portfolio in part because we are starting to get enough scale that, we're able to get portfolio wide pricing. And so that is helping, but we're seeing individual assets that were already in our portfolio program, in our master policies, start to get some insurance relief, which has not been the case over the past few years, as anybody will know. I mean, we saw, certain assets, we saw nearly 120% increase in 1 year back in like 2022, 2023. And so I do think insurance does seem to be coming in a bit, which is good. And I don't know if that's just like, more competition moving in or what it is. We could probably bring on an insurance expert. I just know that I'm grateful. It's still astronomically higher than it was 5 years ago. 2x, 2.5x maybe. So it still is way outstripped inflation, but at least it's we're getting a little bit of relief right now and it's not going the other way. On the people side, on the salary side, I mean, I cannot believe the dearth of for what we are willing to pay right now. We find time and time again that the number one indicator of success are the employees we have on the ground, and a great site staff will be the difference between a property running at 98% and 2-day work orders and, 15-day work orders and 90%, right? Just time. I mean, very rarely have we discovered something that it doesn't come down to the team we have on site. And we have, there's almost no limit to what we were willing to pay for great people. But at the end of the day, it is really hard. We found it really hard to find employees at even the price points where we're at, where we are paying, we are paying more oftentimes, we're paying well more than, than skilled, like, medical staff labor, right? And people that seem to care, not always, we do have, we've some really great teams, but it is, we really have to search for people that give a crap, that give a damn about what they're doing and, are passionate about it. And I'm amazed at, at the salaries we pay, that we're offering, and still how hard it is to find great talent. So
That's when it goes against the narrative, right? That, where everyone's there's no job, AI is going to eat our lunch. There's not going to be any jobs. It sounds like there's still, in a lot of places, this mismatch between demand and supply. And it's not a simple equation, right?
yeah. Although the thing that's going to get me canceled is the thing that excites me as an owner. And I've said this before, right? Like almost all prop tech companies, and especially in the AI space, they're essentially trying to solve for the fact that it's so hard to hire good people. And so can we automate it, because it is so hard to find good talent, that can we give it to an AI that, never fails, right? They always follow up. They always do this task. They never let things fall through the cracks. I have to say, I understand that. I think it is really hard right now, and this is a point that I'll, kind of pound the table on them. I'm very, what we've, it has been very hard to find great talent that cares, that is willing to, and at almost any price point, for what we're willing to pay. And, sometimes that does, as an executive where you have a lot of people working for you, and it is so hard to find people that will consistently show up, execute on the SOP. AI starts to sound really, really.
Yeah. So maybe we'll hit on that. We didn't really have that in the docket or the agenda at all, but maybe it's worth touching on. And I don't know if Doug, Hans, you guys are, obviously, I know Cody, we're using AI in a lot of spaces where we think we can add value and add the better customer experience. Hans, Doug, as you're getting updates from other sponsors and having conversations with other folks right now, where are people finding opportunities to maybe cut that additional staff member at the site? Where are you maybe seeing AI start to come into play in a meaningful way that actually drives NOI growth, right? It's great to have some voice AI that can answer after hours calls, and that's like snazzy and it sounds great. But does that actually drive NOI growth, or is that just a nice thing to put on Twitter, right? And so have you guys?
I've heard some
have
of
you-
the leasing. I mean, you guys probably know more maybe than we do, but I've heard some of the leasing stuff is so good now that people come into the office asking to talk to a lease. Like they,
They
so I
do.
mean,
I will say the flip side of that, what we're finding, we were one of the first to implement it, and we saw a huge uptick. And now what we're finding is it's kind of plateaued, and we're trying to push on our people to beat the AI to the punch, because we do find when it is a real person that they are more successful at booking tours, at all those things, that human connection. They have a much higher conversion rate than the AI. The AI, where we saw the biggest jump at the AI, I do think was at the low hanging fruit, which was like off hours conversations when we just have no one in the office. And yes, AI is better than nothing, but right now it's so funny. We're almost
people are still better.
we're swinging to the other pendulum, where we're trying to get our people to stop relying on AI, because we do know that a good salesperson, for example, is much more effective at booking a tour.
I mean, this is also interesting. I say with my own personal usage, which a lot of our stuff seems to be operational, for our own funds and administrative, I should say. But I personally swung from like, oh my God, I'm wasting so much time trying to get AI to do what I need, because I keep iterating and it's not doing it. And then it suddenly does. And you're like, oh my God, I've saved so much time. So, I mean, there's this weird transition period where it's, trying to, I guess the other area that I've heard, and you guys probably, again, know more of this than we do, but that maintenance, I think, has now a vast library of data available to them to help debug issues, with AI. Those are kind of the two big ones, some of the big ones I've heard.
Well, I mean, there's also what we're looking at, Doug, now is, since a lot of work we do is asset managing or keeping tabs on financials, which does in the end eventually affect NOI, because if you are paying attention to financials, then you can make suggested changes or push whoever you're partnered with or you're investing with. And so one of those is what we're looking at right now, right? Where we can get a feed from the property financials directly into some sort of a report on a weekly or monthly basis, where we're not just waiting on quarterly reports. We're actually getting reporting that's real time. And it's reporting that is catered to our needs and what we need to see. So that's in the works, but it's, I can see that being a game changer.
You know what I'm interested in, and this is going a little bit further out, but I'm kind of interested in where robotics is going to play in too.
I can't wait for the robot to clean my dishes.
I'm
just waiting.
Totally. No,
I'm so excited.
I just wanted to pick up my kids' toys. Like if that's all
that's another great one.
if that's all it does, it's worth 30 grand. I don't know.
Right.
I mean, it's
the
I'm
subscription model on that's going to be a $1 trillion business, right? It's like if you could just have a couple of robots, air dropped to your house that clean your house when you're out. I mean, that would be fantastic, right?
No, I would have one doing stuff all day long, every day. I mean, it'd be doing my laundry. It would be cooking for
Robot
me.
labor laws will be around the bend.
Oh, but then when they get data kind of sentient, you have to worry about that, Doug.
Right. Yes. And then we need mental health support and all sorts of things.
I mean, I'm excited about robots. I don't know when it's going to play into multifamily exactly. I mean, for maintenance or other things, I'm not sure, but
make ready cleans, stuff like that.
I can't. I'm super psyched about robots. I mean, there are some you can buy now that will do your dishes and things. I just don't think they're great. So it's going to get better.
Yeah, I saw one where like the robot, it's a robot, it looks like a human, but there's still someone controlling the robot doing your dishes in your house. And so I don't know if that's
I haven't seen that.
enough. And it's just like they're controlling it from somewhere else. It's not actually doing the work itself. And, it's more just being manipulated by someone else. But I think that's all part of the training process to eventually be able to manage the process of dishes, which is, I guess, complicated for a robot. It's
entering.
So must be complicated.
It's entering our lives. I will say I've been upset. I've been a Tesla owner for a while, and hopefully I can admit that without getting flamed. But I've hated the self-driving forever, and it's actually gotten to the point it's incredible now. So I mean, it will literally take me from door to door, and I don't have to do anything. And I'm like, wow, like what a game changer that's going to be when it can take my kids. When it can
and go work for you, right? You could just let it, hey, go and join the pool of cars and make me some money
too,
right?
Totally.
Cost. I think that's probably going to increase the pricing of the car, right? But I love that idea. Listen, we're way over on time today, so I'm going to wrap it up here. So Doug, Hans, Cody, thank you so much. And this is everything we talked about today. It's why we do the panel format. Lots of perspectives, one conversation, and hopefully we got some signal out of the noise for everyone who's listening. Quick recap on those who were or not taking notes. Almost $1 trillion of CRE maturities this year. The wall is real. Prepare to see some headlines on what that means this year and next. Watch out for those 21 and 22 vintage deals, the floating rate debt, thin reserves, sponsors who have gone quiet. That's going to be an opportunity for some and a struggle for others. Distressed opportunity is coming and timing matters. So keep a lookout for that summertime. I think that's going to be a big one. Some of the operating expense trends, the stories that we were telling in 21, 22, 23, maybe those are starting to crest. The insurance conversation that Cody brought up about how insurance is starting to come over. And then labor, the job market, we talked about this at the top, not as strong as it was. So are we going to see this pricing pressure? Is labor going to continue to have the upper hand if there are not a lot of jobs? And I think we're starting to see that a little bit in sentiment. And then if you're an LP, make sure that you're looking at debt structure, sponsor liquidity, and what happens if rates stay exactly where they are, which is where they've been for the last few years. So if you've got value out of this episode, please share it with someone in your network and that needs to hear it. Please leave us a review. If you want to connect with any of us directly, Doug and Hans are at boxwilson.com. Yeah, no, yes, okay. And Cody at investwithcarbon.com. And of course, you can find me on LinkedIn. So that's the deal flow for January, and we'll see you next month. Thank you so much.
All right.
Thank you.